All right, so stocks finished a down week on a relatively high note. Decent bullish move to the upside, starting a new quarter. Right, we ended the quarter on Thursday. A pretty negative quarter, one of the most negative quarters that we've seen. Typically, the size of the decline that we see in this quarter kind of ends bear markets, and again, like 7 to 10 quarter long bear markets. We are 2 quarters in, and typically these kind of 2 quarter losses usually start bear markets. So the question is whether or not we can't start a bear market until we finish the correction. So have we finished the correction? Are we bullish enough now, or what would it look like next week if we're going to be bullish enough to end the correction, or what are we going to look like next week if we're still in it? So that's kind of what I break down in today's video. Kind of showing you some pretty interesting moves in bonds and what they're telling us. Pretty much other safe haven trades and what they're telling us as safe havens rally here in the next few weeks. What that could mean in terms of whether or not we're done with this correction or not. So let's go ahead and get started. Today is Friday, July the 1st, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. Before we go too far, I invite you to subscribe to our YouTube channel, hit that thumbs up icon, like the video, comment on the video, join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, as you check out some of these other things over here on the right, come down here, click this heart icon. It opens up a new tab. Hit that like button. Also, click this thumbs up icon. Opens up another new tab. Hit that like button. Again, the more you do that, it helps get our content out to more of our followers. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we finished the week going into a new quarter, a new half of the year. With an update, closing up above yesterday's high point. Not quite, a significant change in the range, but still a close above the high of the low day, so to speak. We are still less than 2.5% below the moving average, so we're not quite in the good graces yet. And we're also, again, we have all four of these lines, and we're kind of re-entering, got back above that black line, which is the 38% retracement of the post-COVID rally. The red line being the 23% retracement of the post-2009 low rally. So that's obviously a 13-year move. And then you have your green and brown lines here, which are retracement levels of the declines that we've been on. The orange since the beginning of the year, and the green on the current decline that we're on, this current intermediate decline. The orange being a market sentiment decline. Remember, market sentiment's below 20. And it's really, really rare. I mean, again, it didn't get below 20 since the worst, since the bear market washout move of 2008. So, of all the corrections that we had since 2008, the market sentiment line never got below, including this one, below 20. So you can see it's a much different scenario than what we see here. But you see, getting above the 30-day moving average would also kind of change things, because you would be above all these these Fibonacci levels at that time. Your near-term line is back out of bearish territory, so it is that was a brief move into bearish territory. You only had you're at 43 there, so 1-2 days in bearish territory. You did get to pretty low levels, but that was only 2 days, and it's a higher low point. So if we are going to get a higher high point, it would be above all these lines. It would be above the moving average, and it would be above this near-term peak. So if we come out of the gates next week and we really kind of start to push through and get that near-term line back up above 90 again, maybe even get the momentum line above 90 with a good strong rally, then things can really change. We might be at that point of this might be the correction, though. We've talked about this being the biggest momentum decline on the current correction. That doesn't necessarily mean it has to be the low, because a lot of times you can backfill in with slower momentum back to these lows and potentially to lower lows. So that's a possibility. But if we can really kind of break through these and start working our way up to 4,000, then now we're looking at the possibility of this being the correction low point. And starting that, again, 2 to 3 month correction bounce that typically comes off of those lows, which would probably get us through the end of August going into September and October, which seasonally hasn't been the best time of year either. So that's kind of what we're seeing, about as good of a day as you could possibly gotten, despite the fact it was still below average range and below average volume, you'll see in a little bit. But pretty good day nonetheless. So let's go back really quick to the market forecast. Let's take a look at the NASDAQ 100. It did not have as bullish of a day. It's in its near-term line still. It's out of bearish territory, but it's still in neutral zone, and we did not close above that high point. So not nearly as bullish, and we're still 3% below the moving average. And then the Russell 2000, again, near-term line did not go up very much, and we barely got above that high point. And you can see we're still, again, that 38, that 23 and 38 lines, this 38 line we just barely got above on the S&P. We're still way below it on the Russell and the NASDAQ for that matter. So again, here's that same 38 and 23 line on the S&P that we're sitting right on right now. But we're still way below it. So that's why I think the S&P is pretty good chance that it gets below these lines and catches down to these indexes before everybody rallies at that point. Let's take a look at the weekly version for the S&P. And you can see the intermediate line still in the lower reversal zone. The momentum line here, near-term line, did jump up to the upside. It was momentum line drop, so it was a relatively smaller range than what we have been seeing, especially with that gap there. So the momentum line fell because of that, and it was a down week to boot. But your near-term line did rally off of this cluster. And again, very rare weekly cluster. That's why I think that was at least the momentum low point. Whether or not we actually get a new slightly lower low with far less momentum remains to be seen. But that appears to be at least the momentum low on this current correction move. We're still well below the 30-week moving average, dark pink shading in a red line. And so not necessarily like screaming, hey, this is a really bullish pattern here. You take a look at the Hakinyashi, and you can see we actually got a transition candle. Now, typically when you get these transition candles, if we're going to be really bullish, they want to see really bullish candles like that one, right? This isn't hardly a really bullish candle. We did get one last week, but that didn't produce the transition like this one has. So that's not the most bullish. You can see like this one, for example, where we got the green arrow over there. That was a really good bullish week. That's the kind of week you want to see on a transition week, because obviously it's very easy to follow through on that. Not as easy to follow through on this one as a transition. So in fact, our open is going to be pretty much right about the same level, 38.57, and we're actually trading below that instead of way above it by the time we start off next week. So that's the issue. That's why it's kind of hard to follow through on these. And your PPO is still falling. It's still at pretty low levels and still falling. So again, not quite the reversal pattern that you like to see. Your negative indicator is still well above 25. Your positive actually dropped still below 20. So we're above 30 and below 20. So that's actually kind of bearish breakout pattern still. So again, not a reversal yet on that chart. The RSI and the CCI rallied, but again, not quite even into the upper half for RSI or above 100 for the CCI. So we're not really near bullish levels there. We actually still have a bearish trend going here. We're not even close to being above the blue line. We have a weak bearish trend. Again, remember, things kind of change when this drops to zero. And we haven't dropped to zero on this to change things around. I've also kind of talked about, the Arun indicator, looking for this to drop below 70, which it has. The green line to drop below zero, which it has. Now it's up above zero, but it's going to be at zero for the next few days next week. So if we break above this high, then we'll get the third thing we need for a reversal here, which is the green line spiking to 100, right? That basically means that we get a new 4-week high point. Once the red line drops, once the green line hits zero, and then we get a new 4-week high on the day, right? So not, eventually that green line is going to jump up because that's going to be the new high. But it's got to jump all the way to 100 for it to be, as bullish as we need it to be to change the trend and set the low point. From a whole standpoint, we also been looking at that. You can see, we got a transition candle on the daily chart. It's not going to be the most bullish candle on Tuesday. We're starting at 379. We're up to 381.24. So it'd be a pretty small body to begin with when we open up on Tuesday. So we'd have to really follow through with some bullishness. Otherwise, we'll probably end up with another kind of transition candle on Monday too. And you can see the whole average is already pretty much at where we're at here. So we'd have to pull away from that whole average to the upside to keep it green. Because if we go below it, then we're going to, we start to worry about it turning red. And then once we flirt with that parabolic SAR, that's your third thing to flip to the upside. And we're back to being bearish again. I don't think we're going to get down 10% below the 200-day hold. The 200-day hold's falling pretty rapidly. I don't think we're going to have the same momentum. Remember, it was pretty rare. Like, we got this 2%, we had this streak, a 3-day in a row streak of 2% losses or more. Like, we never, like during the COVID decline, we never got a 3-day streak of 2% losses or more. So this is, it's pretty rare what we saw. That was pretty bearish. Again, I think that was kind of the washout for our move to the downside. But I don't think that necessarily means that we might not still go down again to those lows, if not with less momentum this time, if not a little bit lower, down towards that 50% retracement where the 200-week moving averages. Remember, that's where over here you're still below again, you're still in convergence mode because you're still, the MACD is above this moving average. You're still below the 17 days. So we haven't crossed through some important levels yet. But remember, on a weekly basis, we're still below the 8-week moving average. And we're still below, the MACD is still below its moving average. So we haven't even started to converge there, much less you can see the 200-week is going to be slightly lower lows from what we saw a couple weeks ago. Let's take a look at the volatility. Volatility dropped like a rock today, 7%. It dropped easily into neutral territories, very, very low levels for volatility. Down at below 27, you can see the VVIX dropped to its lowest close that we've seen in the past year, down to 85. I think you're setting, it's one thing for it to be 85. You can see the last time the VVIX was at 85, and it was on the way, it was over here. Here, let me do this. Let me draw a horizontal line. Just to kind of give you an idea of where the VIX is at right now. The last time the VVIX was at 85.51. It wasn't pre-COVID. It was actually way over here on October the 25th of 2019 was the last time we had it down there. October 25th of 2019, which is right here. It'd be right there, that day, this day, there, that day. So that day, that's the last day that the VVIX hit 85.51. The VIX closed that day at 12.65. The VIX right now is at 26.70, more than double what the VIX was the last time we were touching this point. So, it kind of goes to show just really how crazy this market is right now. Because the VVIX should not be this low, not for where the VIX is. In fact, if I were to go back to the last time we fell to 85.59, so actually that was a fall down to 85.59. Here was another fall back to 85.59, back in coming off a correction low point. So when we were coming off this correction of fourth quarter 2018, we got down to 85.51 on January the 2nd of 2019. January the 2nd of 2019. So right here. So the VIX on that day had dropped to 23.22, coming off of a really strong peak up here of 125%. A very typical correction low move on volatility, and we were still lower then than we are now, and we are not coming off an extreme peak of 125%. So again, the idea being, you look at VIX 3M, you look at VIX 6M, even longer term, it's still barely below 30. it's still this is very uncommonly high for the VIX 6M to be near 30. When it is at 30, like I've shown you before here, March the 6th of 2020, the last time the VIX 3M was at 30, the VIX closed that day at 42. Right, we closed at 42, not at 26. So on one hand, the VIX is really, really low for where like long-term volatility is, from where I told you before, the ATR being near 2.5% of price. I mean, this is a really, really high level, 2.33% now. The VIX is generally really, really high when we're at these levels. Let me zoom out here so you can kind of see. Here, let me edit this to 2.38 so you can kind of see where we're at right now. So again, we got there in 2019 or 18 during a regular correction. So I won't even look at COVID. I'll just look at a regular correction. 12/21/18 was the last time the ATR got to this point. 12/21/18. The VIX on that day was at 30. So we're lower now. The VIX is lower, about more than 10% lower now than it was then. The other thing too I've pointed out was how high historical volatility is here, near 30%. And it's very uncommon for it to be this high because usually when it's this high, the VIX is also really high. So for these three things, the long-term volatility, the ATR, the relative ATR for the S&P, near 2.5%, and then historical volatility, considering those three factors and where they are, the VIX is only at 26, is unbelievably low for the VIX. But on the other hand, where the VIX is relative to where VVIX is, because the VVIX is extremely low, right? The volatility index is extremely low. So where VVIX is, volatility is actually double where it's normally at this point. So the VVIX suggests that the VIX should be a lot lower. Well, that's obviously not the case because long-term volatility. So which one's wrong, right? In my opinion, the VVIX is the one that's wrong because I think this will rally back up and spike back up to the upside and bring the VIX up along with it. Because remember, the VIX is really low compared to the long-term volatility, the VIX, the ATR, the relative ATR, and the historical volatility. The VIX is really low. So once this spikes back up to its normal levels for where the VIX is right now, then that will most likely bring the VIX up to where it should be relative to those three factors I told you. And that will probably end the correction that we're at right now. And I don't think it'll be an explosive rally on the VIX. I don't think we're going to get to 125%. I think we'll probably get to around 105, if that, by the time all that's happening. But the VIX should get it back above those long-term volatility levels before we ultimately bottom out for good, right, and then turn back around. And again, I think it won't be as we won't have such a sharp rally like we did there from where we were at 23, 24, all the way up to 34. But we'll probably move up towards the high 30s by the time this is all said and done. And like I said, eventually get above those VIX 3M, VIX 6M levels. Get up to where it typically is, or high 30s, low 40s, considering historical volatility, relative ATR, VIX. Get up to those levels. Then we bottom out. That's where the bottom will be, and then we'll get going from there. So what do you think? Do you agree with that assessment? Do you disagree? And again, what will change that is how we close. If we close next week above all those lines I showed you, then that will change all of that. I don't think that we will. We could, but I don't think we will. I think we'll hold this resistance and roll back over. It's kind of a one-day post, new quarter. But I do think and especially with yields falling, as we'll hear in just a second. But I think ultimately it's going to be more bearishness until we finish this correction, and then we rally, right? Then we move up and get below that black and red Fibonacci lines from those long-term rallies. Get below those like we already are in the NASDAQ and the Russell. Get to that 200-week moving average, maybe a smidgen below it. Finish the selling, so get below the lows that the S&P had back in early June. But it doesn't have to be drastic. It's not going to be a hard moment. It might take all month of July to do it. Volatility has in the past, this past year, has risen into expiration dates. The only one it didn't rise into expiration was May, and it pretty much, or excuse me, March was the only one that it didn't. Well, that was at quarter end, and now we're through the quarter end, the June expiration. We're through the quarter end there, going into the quarter end. And so now I expect we'll follow the trend of all these other months and rally into expiration in July, and then potentially on through into the end of the month. So do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What are you looking at that would suggest why you're either a lot more bullish than that, or for that matter, a lot more bearish than that? Post in the comment section down below. All right, now let's talk about what's driving this action today and this week. And you can see the dollar and commodities have been bullish for most of this, past 3 months. This whole quarter essentially has been a really good quarter for the dollar. And then you can see this is kind of right at the very beginning of April there. But let's just look at today first, July 1st, and we'll go down to like a 4-minute chart or whatever. And you can see today it was small caps. Small caps still outpacing the Qs. The Qs had the biggest loss early. Small caps were down with the Qs early on this morning, especially with international stocks down. The dollar being really bullish. We'll take a look at that here in a second. Bonds were really bullish early this morning. Yields falling drastically. We'll see how that looks like here by the time all is said and done. You can see emerging markets finished today down, putting pressure by the dollar. Gold pressure by the dollar. Commodities were up, but lagged behind some of these equity asset classes. Again, pressured by the dollar, by the Russell and real estate doing its thing there. If we take a look at how this whole week went, bonds really rallied the most. So bonds had a great week, following up a pretty decent week last week. If I were to go back out one more week here. So bonds followed up a pretty decent week, relatively, and then boom, had a really good week this week. And you can see commodities, which have been a big winner past this year to date, are just giving back some of those gains. Let's go back here to this week here. So bonds rallied, the dollar was up this week. Global bonds doing okay. You saw that chart that was put out there, that this has been the worst year so far for the global bond market since 1865, when Civil War was ending here in the U.S. This just shows how bad this year has been for global bonds. But they're having a good week this week off their lows. You can see the Qs had a really rough week, down 4%. The S&P was only down 2%. IWM was even less than that. So we've been pretty bearish in our class portfolios on the Qs relative to some of these other U.S. equities, and it's been paying off in terms of how we've protected our portfolio during much of this, our class portfolio that we kind of look at with examples, right, over the course of this year. Gold pressured by the dollar, like I said, international stocks. Actually, with the dollar being as bullish as it was, international stocks outpaced U.S. equities, barely, but outpaced them. For most of this week, it just kind of lost their gains by Friday. So now let's take a look at some of these charts. And I want to take a look at the dollar index first. Remember, this is the dollar against a basket of currencies, 6 other currencies. 70% of it is the euro and the yen. About 50% is the euro. So add on another 20 some odd percent, and that's the yen, or 17% or so. That's the yen. So 70% makes up the euro and the yen, and you can see the dollar had a good day, but off of its highs and not through to new highs. Now when you look at it like against the yen, and yen being a safe haven currency, the dollar actually fell against the yen. So interesting, as bullish as the dollar was, the dollar closed below yesterday's low against the yen. Again, this is a risk-off move. When the yen's more bullish than the dollar, that's a risk-off move. Now, granted, that hasn't been the case for most of this year, right? The dollar really took off because the yen was so. The Bank of Japan has been more relatively accommodative than the Fed has been, so that's put a lot of pressure on the yen. But generally speaking, the yen is a safe haven area in the currency world because again, it doesn't have the yield that the others do. So from a carry standpoint, you pay interest when you are long the yen against some of these other currencies. And so people only do that, of course, when you're looking to park your money and you're looking for your price to be stable, right? To appreciate, but not really depreciate, right? So if you're getting all this little bit of carry interest because you're short the yen and you're long the dollar or anybody else, then yeah, you might be getting some interest, but you might be losing your capital as this pair falls. You're still above the 17-day moving average, so we haven't started this. The MACD is below its moving average, so you're in convergence mode. That's why it's not rallying hardly much anymore. But you haven't really started the fall yet either. Not until you break the 17. That's when the momentum really picks up. And last time it broke the 17, it couldn't get through this 50. It got below 30, but couldn't get the 50. So we'll see if this ends up being the case where we actually do, because now there's a much bigger gap between the 50 and the 200. That's against the yen. Here's the euro, which remember is more than about half of what the dollar index is, comes from this one pair. It did drop. The dollar did rally against the euro, but we did drop. But like I said, on the dollar index, we didn't get down to new lows, and in fact, we got lower shadows at these lows. So I wouldn't necessarily say, okay, here's the dollars going again. In fact, we've converged so much, it's going to be really easy for the euro to break through a lot of these moving averages all at once, which will make it more of a bullish reversal than the last time it got through multiple moving averages all at once. It couldn't get to because there was a gap between 30 and the 50, it just stayed in that gap. Now, the 30 and the 50 are right on top of each other. So you break through those two, and now your gap to fill is all the way up to the 200-day moving average. So you can see the dollar, as great as it was, is kind of poised for a bearish move right now. The 10-year yield, this would be the 7 to 10-year yield bond fund. Look at that breakout above the 50-day moving average. Very significant break on IEF. Very bullish, very, very bullish for IEF to get above there. TLT. Tried to get above its 50, almost did. I mean, we're above the 17-day. The MACD is rising. The MACD now is above 0. Like it looks like bonds are making a run to fill in that gap, right? They're making a run to the upside after being so bearish for so long. And again, during much of this market decline that we've seen this year to date, typically bonds are a safe haven asset class too. They haven't been. In fact, the safe haven for as people get out of equities, this has been the safe haven, right? The market, the stocks have moved into commodities, and that looks really bullish by itself. But remember, the dollar's been really bullish too. So the commodities have actually really gone bullish. It's actually a little depressed from where it would be had the dollar been bearish, right? If people have been selling the dollar to buy the euro and the yen. But since the dollar itself has been pretty bullish, it's actually kind of weighed down on on commodities, despite the fact that it looks pretty darn bullish as it is. So it kind of goes to show commodities have really been the safe haven during much of this correction. Money has not moved to the yen, right? To safe haven currencies. The other safe haven currency is the franc, and you can see the dollar's been pretty bullish against the franc for most of this year. It's been declining since. But the money hasn't moved into those safety currencies, hasn't moved into long-term bonds, and then gold for much of this year, it rallied initially, went parabolic, and it's actually lower now than where we were when we ended last year, right? We ended last year at 170.96. We're at 168 right now. So gold's actually bear. So money hasn't moved into gold either as a safety trade. And of course, you can think, oh, well, because Bitcoin's a safety trade. Nope. Bitcoin's back below 20,000. So money has not moved into Bitcoin either. So the safety asset class right now for the market for the bulk of this correction so far has been commodities. And typically corrections don't end until commodities fall too. They don't have to fall down drastically, but the money has to start moving into safety trades typically. And it appears that we might, from the move on bonds, from the move on the dollar relative to the yen, it appears that the money might start moving into these safety asset classes for what would probably be the last leg lower on this current correction. Let's take a look at how the sectors have performed. Again, from a sector standpoint, from just in the U.S. equities, it has been a pretty risk-off move year to date. Of course, your three-headed monster, technology, communication services, and discretionary, all down 30% or off 25 to 30%. Not a surprise. Staples and and utilities and healthcare are down, but way outperforming. Energy is actually up 30%. So again, not necessarily, but it's well off of. It's lost 50% of its gains this year to date so far. So well off of its highs. And you can see now it looks like here we're starting to get our last leg lower as these areas, cyclical areas, kind of stay flat, and these safety areas rally. It appears that market is moving towards safety again for one more time, one leg to the downside, where volatility does catch back up to where it probably should be, and then we set the low again with less momentum than what we saw in early June, but we eventually set the low that we come off of, and then you'll probably be led higher by what was most bearish. So these areas right here will most likely lead us higher through our correction bounce. How long and whether we go up to new highs remains to be seen, right? I don't think we will, but we have to expect that we will until we don't, right? So when we come off this correction low, when we set the low and start to come off of it, you know, we want to be more cyclical, and then we'll watch to see how it lasts, right? How that bounce lasts and how long it lasts, and if we can get back up those Fibonacci resistance levels and get back above those long-term moving averages, and eventually get to new highs. If it can, great. If it can't, then we know we are now the odds of a bear market are even that much higher. If we fail the correction bounce and then move back towards, and then ultimately break down below the 200-week moving average. All right, so now for our trade idea of the day, we want to take a look at a stock. If we're going to look at something that is maybe bullish, it may already be kind of breaking out to the upside, maybe leading the markets, would be the home builders area, which has been hammered, right? They've been hurt pretty hard by these rising mortgage rates. Well, mortgage rates have been falling, and you can see Toll Brothers, among others, have really broken out to the upside, broken about almost a full percentage point above its moving average. So it's not quite breaking out, but it's more bullish than it has been, absent that little brief rally we had there at the end of May, early June. The intermediate line's rising. See back here, the market sentiment line is still really low. Now the market sentiment line is right; they're both rising. Intermediate line's above it. The near-term line's coming off of a bullish near-term low point. It dipped its toe in bearish territory, did not get into the lower reversal zone, is already back in the bullish territory. So a good bullish near-term low. We're already above the prior near-term high point, so we're already to higher near-term highs. If you take a look at like its long-term chart, you can see you are getting a transition candle. And if you look at the type of candle, you can see it's a good bullish move, a good bullish week. So that's a kind of bullish transition candle that, I mean, nothing's 100%, but that's the type of bullish transition candle that can lead to more bullish candles. Because again, we're going to open at 45.28 next week on the Hakinyashi, and we're already trading at 47.07. So we're going to start off with a pretty decently bullish candle to begin with next week. So that's the kind of thing you like to see. When you look at the 3 green arrow chart, we did get 3 green arrows today. Not only did we close above the 30, but we also closed above the 17 and the 50, all on the same day. So we had been below this. We had been flirting with the 17. We're still below it. The MACD was still above it the whole time. Well, today it's kind of going divergent, right? So, and it's a good strong break above the 17. So you have a good opportunity to really get going here and try to fill in that gap up towards the 50-day moving average. Take a look at some of these other indicators. You can see the positive indicator crossed above the 25 level at the same time that the negative crossed below. It has not crossed below 20 yet, but at least it's crossed below 25. If you take a look at the RSI and the CCI, they are getting in the upper halves of the chart. Not quite the bullish levels yet, but definitely getting in the at least in the upper half. Looking at the Ichimoku cloud, the trend strength indicator, we are above the blue line and getting into the cloud with the beginnings of a bullish trend starting here. A little bit more. We were at 1 and at 50 when we first looked at it here for our in our Market Outlook live session today. You can see from a stochastic standpoint, while the S&P itself is still below its moving average and in the midpoint of the chart, the stochastics, or the toll, is above its moving average and into the bullish territory on the chart. So really good bullish move. You can also see too on the hull indicator, you got a bullish reversal pattern here too. So we have the green hull, and you got a bullish candle, really good bullish candle closing above multiple highs, and you got the parabolic star to flip to the downside. So really good bullish breakout pattern there on toll. You can see here too on the Arun indicator. We don't quite have, see we're below 70, we hit 0, we're below 70, and we're really, really close to getting to new highs. In fact, if we don't move anywhere and we stay at these levels, we got about another week of highs. But you can see how easy it's going to be, or it can be, if we were going to break up, continue higher, to get a bullish breakout on the Arun indicator as well. And from a Bollinger Band perspective, you can see that we are into the upper half. We're not into the upper quartile, but at least we're in the upper half of the chart of a bandwidth that's really falling here. You can see, if I were to look at at both of them, the negative momentum is declining, and we have green arrows, so the bands are already outside the Keltner channels, so we have the opportunity for us to really get going for the momentum to change while we have green lines. So kind of like this, the momentum to change from bearish to bullish while we stay green. That can lead to a good bullish move. That's the possibility, right? So the thought on this trade is to come over here to to its options and do a bull put spread. Sell the 45, buy the 30. You can see it puts our break even down there about 43.80. So let me actually set my slice to break even. Set that slice to the chart. If you see here, what it would require to be stopped out, because we're willing to lose whatever. We're willing to lose what we're trying to make on this. So we're trying to make 390. I'm putting $1,000 at risk, but I'm willing to lose 390. So for us to get to that point, to get past this break even and get to the point where we're losing $390, which is down to 41.5, we'd have to break. We'd have to pretty much nullify this break to a new higher near-term high, and pretty much go to a new lower near-term low and get below that one. And that would be significant. I don't think we would do that on a whim. That would be a pretty significant drop, significant enough that I'd be willing just to take a small loss in this trade and move on to something else. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to us at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your weekend. Great holiday weekend. We'll see everybody after the break on Tuesday. All right, bye, everyone.